Much of the personal finance content that you see or read online is for people who earn a salaried income or who have regular sources of income. So there's a lot of advice like save a minimum of 15% of your salary, do a lot of SIPs, max out your EPF, but all of this is actually applicable only to people who have a regular source of income. What if you're a gig worker or a freelancer? Today many people are self-employed and make a living for themselves. This question of money video is going to be about personal finance tips for people with irregular income. Usually investment gurus ask investors to diversify their investments. But for freelancers, it is important to diversify your sources of income also. Even if you have one employer or one client who is rock solid and who is giving you a lot of work, try to diversify your income so that you earn money from at least 2 or 3 sources. This is necessary because suppose that one employer goes bust or decides to switch to somebody else, you will be left bereft of income. You can do the same job for different people or different types of jobs. Once you've been freelancing for a while, try to negotiate a retainer, a fixed payment instead of a piecemeal payment from one client. Even if this retainer is slightly lower than what you would earn otherwise from that client, be happy with it because that's the price you pay for predictability. As a freelancer, you need a social security net against emergencies. So if it's a health emergency such as a hospitalization or surgery, a health insurance cover is your cheapest bet. If you're in your 20s, a health insurance cover of 5 lakh is enough. As you go into your 30s, you can top it up a bit. What about other emergencies such as a job loss, accident or illness? In that case, you will need an emergency fund. Therefore, as soon as you start earning, start putting away money in an FD or RD, which will keep building up to an emergency fund. The emergency fund needs to be equal to 9 months worth of minimum living expenses. It should be withdrawable at any time. As soon as you start earning, open a separate bank account for your investments which is different from your income account. This is necessary because when your income is irregular, when you earn a windfall or a large income in a particular month, there can be a temptation to ramp up your expenses and splurge it all. So make sure that you know what your minimum living expenses are each month and keep only that amount in your income account. Any excess should be immediately swept into the investment account. Use the investment account only to make investments towards your financial goals. Now, doing large SIPs may be very difficult for people with irregular income from their investment account because they won't know the balance all the time. But the good news is that SIPs are not necessary for all asset classes. SIPs are only necessary for equities or equity funds. Therefore, you can use lump sum investments from your investment account for all other kinds of investments. It can be FDs, it can be debt mutual funds, it can be government bonds. All these investments you can do in lump sum without SIPs. So calculate what kind of SIP you can afford to do every month. Even if it is a small amount, do that in an index fund like a Nifty 100 fund or a Nifty Midcap 150 fund. Beyond that, if you have sums to invest in NBFC FDs, invest in good bank FDs, invest it in debt mutual funds, especially money market or corporate bond funds which invest in high quality securities. If regular employees, salaried employees have EPF, Employees Provident Fund, then you need not worry because you have an even better vehicle which is the National Pension System or NPS. The NPS is actually a better retirement vehicle than EPF because it gives you the flexibility to invest varying sums. So you can invest as little as 1,000 a year to keep your NPS account alive. You can invest any amount without a maximum limit. The other advantage of NPS is that up to 75% of your investments can go into equities. Equities give you a good shot at a double-digit return in the long term, which is what you want with a retirement vehicle. So open an NPS account as soon as you start earning and start contributing to it. Of course, the NPS also takes care of your tax saving problem. Up to 2 lakh rupees a year that you put in the NPS is exempt from income tax under section 80C and 80CCD of the Income Tax Act. As your investment kitty grows over time, you can also try to set up passive income streams. Passive income refers to the income like interest, dividends and distributions that you can earn from investing in certain instruments. Some of the vehicles that can give you a very healthy passive income are high dividend yield stocks. You can find them from stock research portals like Screener, REITs, infrastructure investment trusts or InvITs, and also debt mutual funds from which you can do systematic withdrawal plans. What about rental income as passive income? The problem is rental yields in India are only 2 to 3% of the house value, and maintaining a home and managing tenants can be a real pain, so I don't recommend it for young people. As of now, it is better that you stick to passive income vehicles which are made from financial products.